Houston, we have a problem. Inflation is down to 4.9% after being at 5% last month, but it also rose by 0.3% at the same time. Is this a sign of trouble for markets where the Fed is going to continue to raise interest rates, or are we actually headed into an inflationary recession, also called stagflation? In this video, I want to explain why the latest CPI report was indeed a complete mixed bag, as well as understanding how the S&P 500 has historically performed during times of rate hike cycles. Because clearly right now, we have very little certainty on what the Fed is actually going to do. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's rip the band-aid right off. As you can see, year-over-year percentage change of CPI is now down to 4.9% after being at 9% in June of last year. This is clearly significant progress, but there is a significant elephant in the room that markets are inherently starting to price in. And that has all to do with the core CPI index instead. As you can see, in contrast to the previous chart, this chart is relatively still flatlined. Even though this did also peak in the summer of last year, it's not following quite the same trend as the headline number is. And as we all know, the headline number includes food, oil, and gas prices, which are volatile commodities driven by consumer demand on a day-to-day basis. And well, the inflation report that we just got isn't really going in the favor of inflation falling as fast as headline is showing us. As you can see in the April forecast, which came in right in line with what the real data came out, we saw both the month-over-month and the year-over-year numbers actually tick up slightly from March. And more importantly, we saw the core CPI still remain elevated over the headline CPI, which, as I've showed you multiple times, is a very rare occurrence and is typically a sign of inflationary pressures. And this is obviously certainly a big challenge for economists in the US because we're dealing with an impending recession, a debt ceiling crisis, and an upcoming election. Meanwhile, the work that we've been doing for the past 24 months for fighting inflation is not showing that much effort. It seems pretty clear that the labor and housing markets are showing strength in a time of economic downturn. And right now, that is the Fed's worst nightmare. And this is pretty interesting because real inflationary prices that consumers are experiencing are much higher than the CPI inflation prices we see from economists. This has been a pretty big concern for many people who have been voicing their idea around inflation not really falling because their grocery prices, rent, and used car prices are still much more elevated than 2022. But people fail to realize that the CPI number is an average aggregation of various small components throughout the economy. So on average, it will always be lower than the real inflation people experience on a day-to-day basis. And on top of that, we know that shelter CPI lags the performance of US rents by at least 6 months. And for the first time in March, on the good side, we've seen a tick down in the shelter CPI in the orange line from 8.2% to 8.1%, falling right in line with the trend that we've seen of the 6-month lag. Whether or not this plays into the hands of inflation falling over the next 6 months, we have yet to see. But although right now the report on the headline numbers does not look that good, there are some signs in the back end that situations could be improving. And let's be honest, another big reason why core prices are still so sticky, apart from just real estate, is that net profit margins for a lot of companies in the S&P 500 are still quite elevated. This, as a matter of fact, is the reason why so many big tech stocks have been outperforming small cap tech stocks over the past 6 months. As you can see on a year-to-date basis, something like the technology sector, the communication services, and consumer cyclicals have seen insane returns compared to, let's say, healthcare, banks, home improvement, drugs, or even energy and industrials. This is clearly because these large cap tech stocks have much better pricing power to maintain their operating and gross margins. This means they have a better chance of weathering any excessive interest rate hikes the Fed might do, as well as more tightening labor market conditions. As a matter of fact, in Q4 of last year, the S&P 500's EPS growth bottomed, and that timed very perfectly with the price action of the market itself. Right now, the S&P 500 is up around 15% from its all-time lows, and that trend is consistent with, as you can clearly see, what EPSs have done. And bear in mind that this chart from Bloomberg is X energy. This, paired with the fact that most of the S&P 500 companies in this current earnings season have beaten analyst estimates, it really sets up a good recipe for understanding why markets have rallied so much. The S&P 500 and Nasdaq being up so much is fully warranted, even though the core inflation is not falling as fast as we want, because the market cares much more about pricing power and EPS, which unfortunately also results in core inflationary pressures. And although I have not lived through a time when we have seen such high inflation paired with an oncoming recession, I can always look at previous data over the past 30 to 40 years on how markets have performed during hiking cycles. And as you can see, whenever the Fed has started hiking rates, on average it takes around 16 months from them to stop hiking, whether that be pausing rate hikes and holding it at a constant level or starting to cut rates. And as you can see, the average performance of equities 6 months after that specific inflection point is anywhere from 15.7 to 23.7%. And as a matter of fact, believe it or not, during the hiking cycle itself, an average of 10% was earned for every hiking cycle since 1988. And as you can see, although history does not repeat itself, history does tend to rhyme. And since the hiking cycle for right now started back in March of 2022, we are following that trajectory on the Nasdaq and the S&P 500. So the bottom line is, don't be surprised if this rally in the overall indices continues for the rest of the year, even if the Fed is pausing rate cuts and potentially even raising rates. This is just how the market performs, because this index is driven mostly by pricing power strength. It's by companies like Apple, Microsoft, and Google that have insane ability to raise prices and recover from the recession that we have consistently seen since last year. What do you guys think? Will the S&P 500 recover to its latest 2022 high of 4,300 by the end of this year? Or are we just going to see sideways action until the end of this year? Let me know your thoughts down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.